Hello friends, welcome to my channel Finance Eco India. Today DMart's Q1 results are out and it's a mixed bag. Revenue surged 16% year on year to 15,932 crores, but margins slipped and profit barely inched up. Will the retail giant sustain its growth or face serious headwinds? We are breaking it all down, from store expansion to online impact and margin pressure. So hit subscribe, turn on notification and stay till the end. I will share what analysts from JM Financial, HSBC and JP Morgan are actually saying. So firstly take the snapshot of the result and then we will discuss in detail in next slides. Revenue surged 16% driven by store addition, but profit grew only 2% and EBITDA margin dropped to 7.9% from 8.7% a year ago. DMart now operates around 424 stores, so while top line keeps accelerating, profitability shows sign of pressure. Want to know why margins are under pressure and what analysts expect next? Stay tuned because there are a lot more ahead. So talking about the revenue growth, DMart reported 15,932 crore in Q1 revenue, making a 16.2% year-on-year increase, a strong indicator of continued momentum. This growth is largely attributed to adding around 6 to 9 new stores during the quarter, raising the store count to 424 as of June 30, 2025. However, while store addition are fueling top-line gain, same-store sales growth is slowing, suggesting that core store performance is moderating even as expansion continues. So DMart's impressive revenue growth is clearly driven by scale. More store, more sales. But the slowdown in existing store performance means the company must focus now on operational efficiency and optimizing new location to maintain healthy growth. So now let's discuss about the profit and profit margins. So DMart Q1 financial year 26 net profit rose modestly to Rs 830 crore, making a mere 2% increase year on year from Rs 812 crore last year. EBITDA and margin pressure. Meanwhile, EBITDA climbed 6.4% year on year, reflecting cost absorption in absolute terms. But the EBITDA margin shrank sharply to 7.94%, down from 8.68% a year earlier, a drop of 74 basis points. So what's driving the margin hit? Rising operational cost due to continued store rollout and upstick in staff and overhead expansion. Heightened competition, especially in metro region from quick commerce platform offering lower prices and delivery convenience. So while the bottom line shows growth, the shrinking margin reveals underlying pressure. DMart's aggressive expansion strategy and competitive pricing model are taking a toll on efficiency. This suggests the company's low-cost leadership is being tested by rising cost and market revenue, even as it continues to grow. So let's discuss why DMart margins are under pressure and why it matters. Quick commerce competition in metro area is hurting pricing power and customer draw, as Goldman, Morgan Stanley and JP Morgan have flagged this trend. Operation costs are rising due to increased staff and higher overhead from new store rollouts, in line with brokerage preview that expect a 40 to 54% BPS hit to EBITDA margin. Weak discretionary spending, particularly in apparel and general merchandise, has also compressed margins, with the CEO confirming the drop in gross margin due to softer non-FMG sales. So this margin compression isn't just about numbers, it highlights that DMart's low-cost retail edge is being tested by newer, faster competitors, rising cost and evolving retail mix. This is a critical area to watch for Q2 and beyond. So now let's discuss the analyst projection and is the DMart result is a hit or a miss. So ahead of results, analysts projected 18% revenue growth to 16 to 16.5 thousand crore, EBITDA margin between 8.2 to 8.7, and PAT rising 6 to 10% to 817 crore to 892 crore. So actual results are revealed. Revenue increased 16% year on year to 15.9 thousand crore, slightly below the top end of the estimates. EBITDA margin compressed to 7.9%, underperforming the 8.2 to 8.7 forecast. PAT rose just 2% to 830 crore, significantly lower than the 6 to 10% expected. So the top line growth was strong at marginally short of expectation, but the sharper than expectation margin contraction and muted profit growth delivered a mixed message to the market. DMart's expansion worked in driving sales, but cost pressure and competition pulled profitability down. So now let's discuss about the DMart's growth drivers. In Q1 financial year 26, DMart added 6 to 9 new stores, bringing its total count to approximately 424 outlets. That's part of a steady growth strategy, but here's the twist. Same-store sales growth, a key measure of performance in existing location, has declined significantly. It fell from 8.4% in Q1 financial year 25 to just 3 to 4% this quarter. So why this matters? While new stores are boosting overall revenue, the slowdown in established outlets shows weakening underlying demand. DMart is still growing, but the engine is losing steam. Keep a close eye on SSSG next quarter. It will determine if this slowdown is temporary or something deeper in consumer spending. Let's now discuss the DMart's major risks and concerns. DMart's profitability is under pressure from three key market challenges. First one is quick commerce competition. Rapid delivery services are snapping up customer metro areas, and brokers like HSBC, Macquarie, and NDTV Profit warn this trend may intensify further. Inflation is eroding consumer spend. So due to high inflation, consumers are only tied to the household budgets and they reduce spending on the non-essential items. So this led to sluggish discretionary demand. Categories like apparel and general merchandise have slowed sharply, confirmed by Motilal Oswal and Mint analysis. So these stress of fast, cheaper and delivery alternatives. Cost-driven consumer, belt tightening and discretionary slumps are testing DMart's low-cost leadership and growth stage. Navigating these headwinds will be critical in upcoming quarter as they reshape India's retail landscape. So let's discuss the stock market reaction on this result, as although the result has came after the closing of the market, DMart stock opened slightly lower today, around 4,160, trading flat to moderately down on the day, reflect hesitant investor sentiment following the results. Analysts have mixed reactions. HSBC, Macquarie and IFL are cautious, pointing to margin compression and intensifying competition in urban market. JM Financial, on the other hand, is more optimistic, noting that revenue growth remains solid and the stock may offer value at current levels. Overall, the market reaction is muted. Strong top-line performance was offset by margin pressure, leaving analysts split. Margin outlook and competitive dynamics will likely shape the next move. Let's now talk about the management commentary. This quarter marks the first earnings session under the backdrop of major leadership shift from DMart. Anshul Aswana, a seasoned Unilever executive and IIT-IM alumni, joined as CEO designate on March 15, 2025 and is set to officially succeed Neville Norana as MD and CEO on February 1, 2026. Nora, who built DMart from a 5-store operation to over 380 outlets, announced he would step down after his term ends in January 2026, staying on to ensure a smooth handover. Why it matters? Investors are closely watching this transition. Nora's era shaped DMart low-cost, high-efficiency model. Aswa inherit this legacy and must maintain growing challenges in the retail sector. The market reaction to this vision and early moves will be pivotal for DMart's future momentum. So let's discuss about the final verdict. Should we buy, hold or sell this stock? So DMart continues to deliver strong revenue growth, but this quarter's margin is squeezed and slowing same-store sales raise cautious flags, especially as profit growth lagged. So what are the watch lists for Q2? What should we watch for this stock to buy for Q2? Margin recovery. Can DMart re-expand margin from 7.9% now? Same-store sales growth stabilization. Will core store performance improve? CEO transition clarity. Will the management handover remain smooth? So what should be our strategy? For long-term investors, consider accumulating selectively given DMAR's strong footprint and deep value. For short-term trader, wait for clear margin signals and stabilize same-store sales before taking position. So revenue remains a growth engine, but profit efficiency and store health needs more resilience. Keep those eye-level benchmark in Q2 before making your next trade or investment move. So we have discussed a lot about the DMart. Now let's sum up and wrap up this session. DMart shows expansion strength, but margins are a concern. Will upcoming quarter ease competitive pressure? Let me know your views on this and comment below. Like, subscribe and hit that bell icon. And check out our next video for more other companies updates and results. Thank you.